Your 401k is up 14% this year. Your retirement target, adjusted for the actual cost of the life you are planning, is down 21%. Both numbers can be true at the same time. The system that made them simultaneously true is older than you are, and it has a name. This is case file 003. We are going to walk the math. I'm Cipher. This is CipherHedge, where we show the math behind the systems built to move your money somewhere you didn't agree to. Public data, public filings, education only. Subscribe if the next 13 minutes hold up. The median 401k balance at age 60 in the United States is roughly $230,000. That is the headline number from the most recent Federal Reserve Survey of Consumer Finances, confirmed against the Investment Company Institute's annual 401k report. Now run that against a 30-year retirement at 2026 healthcare and housing prices. At a 4% withdrawal rate, we will come back to that number. It funds approximately 8 to 11 years of inflation-adjusted spending at the household's pre-retirement standard of living, depending on what you assume about Social Security. The shortfall, in actual dollars, for a top quartile earner expecting median life expectancy between $400,000 and $750,000. That is not a mood. That is the arithmetic of what your statement is telling you. By 13 minutes from now, you will have 3 things. A portal walkthrough you can run on your own plan in 5 minutes. A 3-move posture you can execute before next quarter's statement lands. And a downloadable decoder, free, that does the audit for you on paper. Stay with it. There are 4 pieces of plumbing. Once you can see them, you cannot unsee them. Piece 1. Expense ratio compounding. The industry average actively managed mutual fund expense ratio is 0.74%. The index alternative, broad market, low cost, mechanical, is 0.04%. Source: Morningstar U.S. Fund Fee Study, cross-confirmed against ICI. Now run a 30-year working career. $50,000 starting balance. $500 per month contribution. 7% nominal return. Watch what happens. $396,000. Same contributions, same returns. The only variable is which expense ratio you were sitting in. That is the cost of 70 basis points compounded over 30 years. Piece 2. The auto-enrollment default fund trap. Roughly 75% of 401k plans now auto-enroll new hires. The default fund, the one you wake up in if you never made an active choice, is almost always a target date fund at the plan administrator's house family. Same plan administrator collects the record-keeping fee and the fund expense ratio on the same dollars. Same firm, 2 revenue lines. Same target date, same equity tilt. Expense ratios ranging from 8 basis points to 51 basis points. A 6-time spread. If you got auto-enrolled into the higher number, nobody asked you. Nobody had to. Piece 3. Tax deferred is not tax-free. The 401k defers federal income tax on contributions and adds it back at withdrawal. If your withdrawal year marginal bracket is higher than your contribution year bracket, and that is a real possibility for high savers, top bracket retirees, or anyone who lives in a state that taxes retirement income, the math flips negative versus a Roth alternative. Same dollar in, different dollar out. The difference is which tax bracket meets it on the way back. This is not a recommendation to switch to Roth. It is a recommendation to do the bracket spread math before you assume the wrapper is doing what you think it is doing. Your tax preparer can run the numbers in 15 minutes. Piece 4. The 4% rule is mostly archaeology. William Bengen's 1994 SafeMax paper used returns from 1926 through 1995 and a 30-year horizon. Current academic consensus, Wade Pfau 2023, Morningstar 2024, is closer to 3.0 to 3.3% on the same horizon under 2026 valuations and the post-2020 inflation regime. If your retirement plan was built on 4%, your retirement plan was built on a chart from before the internet. The bridge is older than your kids. So who runs this? Let's name them. 4 plan administrators run the bulk of U.S. workplace-defined contribution plans, ranked by participant count. Fidelity Workplace Investing, about 22 million participants. Privately held by the Johnson family. Empower Retirement, about 17 million. Subsidiary of Great-West Lifeco, ticker GWO on the Toronto Stock Exchange. Majority owned by Power Corporation of Canada, ticker POW.TO. Principal Financial Group, about 10 million. Ticker PFG on the New York Stock Exchange. Vanguard Group Institutional, about 5 million. Privately held, mutual structure, owned by its fund's shareholders. Then the fund families inside the default menus. BlackRock, ticker BLK, about $11 trillion under management. Their LifePath Index series dominates non-house TDF placement in plans that do not use the administrator's own family. T. Rowe Price, ticker TROW, about $1.5 trillion. Their retirement series sits in many plan menus. Capital Group, which runs the American Funds family, privately held, about $2.7 trillion. Recurring placement in non-index menus. Now the structural piece. Plan administrators bundle record-keeping with their own house mutual fund family. The same firm collects the administration fee from the plan and the expense ratio on the funds it puts in front of you. Two revenue lines on the same dollars. This is fully legal. It is fully disclosed in DOL Form 5500. And it is exactly the structure the Department of Labor has been litigating since the 2015 Supreme Court decision in Tibble versus Edison. Tibble established that plan fiduciaries have an ongoing duty to monitor and replace high-cost funds, not just at plan launch, but every year in perpetuity. The 2022 Hughes versus Northwestern decision applied the same duty plan by plan, fund by fund. The case law is settled. The compliance on the ground is uneven. Your plan's fiduciary has a SCOTUS-affirmed duty to monitor what you are sitting in. Whether they are doing it well, you can find out in 5 minutes. We are about to walk you through how. This part is the show don't tell. We are going to open the Department of Labor's EFAST portal, efast.dol.gov, and look up a real plan. Step 1. Search by your employer name or your plan's EIN. Your benefits coordinator can give you the EIN, or you can find it on your last year tax statements. Step 2. Find your plan in the results. Most employers file a single Form 5500 for the whole plan. You will recognize yours by the participant count and the plan year. Step 3. Open Schedule C, Service Provider Compensation. This is the line that tells you how much each vendor was paid by your plan in the most recent year on file. Record keeper, investment manager, auditor, custodian. Each line by name, each amount in dollars. Step 4. Open Schedule H, Financial Information. The line at the bottom says Total Plan Expenses. Divide that number by your plan's end-of-year asset balance. That percentage is what your plan, in aggregate, paid in fees that year. If that aggregate plan cost percentage is above 40 basis points, your plan is in the upper cost half of U.S. workplace plans. If it is above 70 basis points, it is in the upper quartile. If it is above 1 full percent, the plan fiduciary has a Tibble grade question to answer. This took 5 minutes. You can do it tonight. The data is public. The portal is free. The reason most workers do not know about it is that nobody told them. Hold on to the median balance number. You are about to need it. Worked example. A 35-year-old top quartile earner, salary $130,000, contributing 10% of salary plus a 4% employer match. 30 years to age 65. 7% nominal returns. Default fund is Fidelity Freedom 2050. Expense ratio 51 basis points. End balance at 65, approximately $1.42 million. Sounds like a lot. Same contributions, same returns, but the default fund is Vanguard Target Retirement 2050 at 8 basis points, or BlackRock LifePath Index 2050 at 9. End balance, approximately $1.79 million. $370,000. Same person, same job, same investment thesis, same market. The gap is not market timing. The gap is not luck. The gap is 43 basis points compounded across 30 years, paid quarter by quarter to the fund family that ran the default fund. The viewer paid the tax in full and received no receipt. If that example makes you uncomfortable, that is the appropriate response. It also tells you exactly what the next move is. 3 moves. You can run all 3 this week. Move 1. Capture the employer match floor. If your employer matches dollar for dollar up to 4%, you contribute at least 4%. That is 100% return on every matched dollar before the market touches it. There is no investment math counter-argument to this. None. If you are not capturing the full match, you are leaving wages on the table that your employer has already authorized. Wages that are sitting in the plan budget waiting for you to claim them. Fix this first. Move 2. Audit your plan's expense ratios. Run the DOL EFAST walkthrough we just showed you. Pull the prospectus of whatever default fund you are sitting in. If the expense ratio is above 20 basis points on a target date fund, file a written request with HR or benefits asking what the menu's index equivalent option is. Most plans carry one. Most participants do not know the ticker. The written request itself is the move. You are not making a complaint. You are asking a documented question. Once the question is in writing, your plan fiduciary's clock is ticking. Remember Tibble versus Edison. The Supreme Court said your fiduciary has an ongoing duty to monitor and replace high-cost funds. Your written request just made the monitoring concrete. Move 3. Build the brokerage sleeve for after-tax savings beyond the employer match. Index Foundation. VTI, VOO, VTSAX, SCHB. Expense ratios at 3 to 4 basis points. Available through Schwab, through Fidelity Brokerage, which is a separate entity from Fidelity Workplace, important distinction, or through Vanguard Direct. Same ticker grid we shipped in the launch episode's defensive move. Education only. Talk to a fiduciary before sizing any position in your own account. Closing line. The 401k was sold to you as your retirement plan. It is operating as someone else's asset management business. The structure is fully disclosed. The opt-out is fully available. Refuse to subsidize the gap silently. One last thing. I built a one-page decoder, PDF, free, that walks you through the line items most workers cannot read on their own quarterly statement. The match capture worksheet, the expense ratio audit, the Roth versus traditional decision tree, the Form 5500 lookup, 5 minutes against your real statement before next quarter's lands. Comment statement below this video. I will send it to you. No spam, no upsell. The link is also in the description and the pinned comment. Quick disclosure. When this channel names tickers, I will tell you whether the channel or I hold them. Today, any positions are disclosed on screen above and pinned in the comments. Education only. Talk to a licensed fiduciary before sizing anything in your own account. Case file 003 is closed. If this is your first time on the channel, the description has the methodology, the source list, and a free decoder PDF that lets you run this on your own statement. Next Tuesday, the bigger picture behind today's episode. The cost of the life this 401k was supposed to fund, traced to the buyers who absorbed the supply. CF-001 next week. Education only, not advice. Talk to a fiduciary before you do anything with your own money. See you Tuesday.